Today we're going to discuss the differences between common stock and preferred stock. Common stock is, common. When people talk about stocks, generally they're referring to this type of stock. In fact, the majority of stock that is issued is in this form of common stock. Common shares represent ownership in a company and acclaimed dividends on portions of profits. Investors get one vote per share to elect board members, and those board members basically oversee a lot of the decisions that are made by management. Over the long term, common stock, by means of capital growth, they yield higher returns than most any other type of investment. This higher return comes at a cost, since common stock basically entails the most risk. If a company goes bankrupt, liquidates, the common shareholders will not receive basically any money until creditors, bondholders, and preferred shareholders are all paid off. So common stock, you're basically the last to get paid in the event that the company goes under or something like that. Preferred stock, however, preferred stock represents some degree of ownership in a company, but usually does not come with the same voting rights. This may vary depending on the company, though. With preferred shares, investors are usually guaranteed a fixed dividend forever, as long as they hold the preferred shares. It's a little different than common stock. You can get dividends with common stock, but they're variable. They can change all the time. There's no guaranteed dividend, and sometimes they can choose to not give you a dividend at all. Another advantage is that in the event of a liquidation, preferred shareholders are paid off before common shareholders, but still after debt holders. So debt holders would come first, then preferred stockholders would get paid after that. The other thing about preferred stock is it may be callable. And what that means is that the company has the option to purchase the shares from the shareholders at any time for basically any reason whatsoever. Now, when they do that, it typically will be at a premium. Some people consider preferred stock to be more like debt than equity. A good way to think about these kinds of shares is basically seeing them as a in-between of bonds and common stock. So companies can issue bonds. They can also issue common stock, and obviously preferred stock. Preferred stock is like that middle ground between a bond and regular common stock. Now, why do companies offer preferred stock, the option of common stock? Why might they choose to do preferred? Issuing preferred shares can basically help a company achieve a lower debt-to-equity ratio compared to issuing debt bonds. Companies use this technique in order to manage the balance sheets. This makes the stock look more appealing to potential investors who usually opt to invest in companies with a lower debt-to-equity ratio. Preferred stock is generally considered less volatile than common stock, but typically has less potential for profit. So when you think about it, common stock, it's more volatile. You can make more money. It's obviously more risky. Preferred stock, it's a little less risky, but it's more of a safer way to go. Now, what is the advantage of preferred stock over common stock? One advantage of preferred stocks is their tendency to pay a higher and more regular dividend than the same company's common stock. Preferred stock typically comes with a stated dividend. The company that sold you the preferred stock can usually, but not always, force you to sell the shares back at a predetermined price. And those companies might choose to call the preferred stock, like I talked about before, if the interest rates that they're paying are significantly higher than the going market rate. So if they're noticing that the market rate, they can get a better deal, that's probably about the time they're going to go ahead and make that call and have those shares bought back by the company. Another question is, can you convert preferred stock to common stock? Convertible preferred stock can be exchanged for a predetermined number of a company's common stock shares, but once converted, the common stock cannot go back to preferred. So it's kind of a one-way street. Once you go ahead and you change that stock over and you convert it, from the preferred to the common. You can't go back the other way. It's pretty much stuck at that point. Do preferred stocks appreciate in value? Like bonds, preferred stocks pay a dividend based on a percentage of the fixed face value. It's possible, though, for preferred stocks to appreciate on market value based on positive company valuation, although there's a less common result, obviously, than with common stocks. That's basically the main differences between common stock and preferred stock. So go ahead, give us a subscribe, click the bell, do all that fancy stuff. We got more videos coming out on the basics of investing, stock market, and things like that. So stay tuned. If you have any questions, go ahead, drop them in the comments below. I will make sure to get to them. This is a new series, so a lot of people don't know about it yet, but there's lots and lots to talk about. So we will get to it, and I will see you next time.